This is the S&P 500 in 2025. At first glance, it looks like a victory lap. Nearly all-time highs. A powerful rebound. Investors celebrating resilience. This chart is not a story about strength. It's a story about volatility, fragility, and policy distortion, and it's quietly warning anyone paying attention. Again, you got to stop realizing what's really going on. Because the most important thing on this chart is not the new high. So let's start on the left side, right? So if you look at the chart on the left side, what you're seeing, we start in January 2025 until December of 2025. Okay. So from February 19th high to the April 7th low, the S&P fell 21%. And we kind of know why, right? That is not a pullback. That is not a healthy consolidation. That is a bear market scale drawdown in less than 7 weeks at the beginning of the year. There was no recession declaration, no financial crisis headline, no Lehman Brothers, just a hair pocket. Liquidity vanished. Volatility exploded. Risk parity, system funds, and leverage strategies were forced sellers. So this was not a reminder. Markets don't need bad news to break. They just need positioning to unwind. Now look at what happens next. From April 7th low to the December 11th close, the index rallied 43%. 43%. That is not normal. That is not organic growth. We didn't do that fast. We didn't grow that fast. Right? And there's no earnings compounding. This is liquidity-driven reflation. Lots of money going into the system, pushing everything up. So that is what happens when markets assume the Fed will blink. 2, when financial conditions loosen despite restrictive policy. 3, investors are conditioned to buy every dip. The psychology flips instantly from panic to euphoria. The pain was erased so quickly that investors never had time to recalibrate the risk. And that matters because fast recoveries don't cleanse the markets. They sanitize them. New focus, right? Take a look at the green diagonal line. You see that green line plus 43%? This upward trend line from the April lows has become the market's religion. Every sell-off stops here. Every dip buyer leans on it. Every algorithm reinforces it. But here's the danger. Trend lines don't fall gradually. They fell suddenly. Right? It doesn't do like, it goes like that. And the more times they are tested, the weaker they become. Markets are not stabilized by support levels. They are more fragile by belief in them. I don't think it's going up, so therefore it's creating a new lane, so it's going to keep going up and up. You're just analyzing a line. Now move to the right side of the chart. In November, the S&P dropped 5.8%. Right? You see that little 5.8% sometime in November, minus 5.8%? That moves matter because, not because of the size, but because of its timing. Right? The timing is important. It happened near an all-time high. It happened with no recession shock. It happened while optimism was peaking. This is what late cycle instability looks like. The market is no longer climbing on disbelief. It is wobbling on confidence. That is when corrections become dangerous. Look at it yourself. Look at the chart. Right? Why? Well, we're doing great, but then why did it dump? Because we're still doing great. I mean, the economy is growing, low unemployment, inflation is under control, the Fed is lowering rate. What is your problem? That the market is no longer remember this. The market is no longer climbing on disbelief. It is wobbling on confidence. That is when corrections become dangerous. Now let's address the most misleading label on this chart, all-time closing high. Right? That just happened. Markets love this phrase. Media love this phrase. And of course, be careful what they tell you most of the time. Because they tell you what benefits them, not what benefits you. I want you to join this channel and to give me a thumbs up as much as you can, because I'm going to help you see through the fog. The S&P 500 hit an all-time highs in 2000, 2007, and late 2021. Each time investors were told, this time is different. The economy is strong. Liquidity is abundant. And each time the market is standing on a fault line. All-time highs are not proof of safety. Per my estimation, you have just about a year or even less before the black swan comes back. They are proof of crowding. This chart tells us three uncomfortable truths. First, the market is no longer pricing fundamentals, it is pricing policy expectation. Every rally legs depend on what investors think the Fed won't do. Second, volatility has become compressed, not eliminated. When it returns violently, as seen in February and November. November, -5, February, -21. Third, this market has trained participants to ignore drawdowns. A 21% collapse was forgotten in weeks. This creates more hazard at the index level. Like somebody just got shot across the street and you're just buying a house there, you don't care? A moral hazard always ends the same way. So here is the takeaway. This is not a bullish chart. This is a fragile equilibrium chart. A market that falls 21% without a recession, then rallies 43% without earnings justification, then flinches back 6% at the high. It's not stable. It is dependent on liquidity, which is a lot of money being pumped into the system. It's dependent on policy credibility. Do you believe what these people are doing? Do you actually believe what the Fed is doing? What they lowered the rates? What are you talking about? But we may have an inflation problem. And I've shown you in a couple of earlier charts that the 2 years and the 10 and the 30 years are like that. That the treasuries, the 10-year treasury is way above the Fed fund rate. It was never that far away because the market does not believe what it's seeing. The market does not believe the Fed. So it is dependent on confidence that's staying intact. And confidence is the most unstable asset in finance. This chart is not telling you to panic. It is telling you to stop being complacent, because the most dangerous market in history didn't collapse at the lows, obviously. They collapsed after new highs convinced everyone it was safe again.